I indicated that annuities, the nice thing about annuities, that it gives you total peace of mind in that once we've agreed to whatever the terms and conditions are, they're basically set, and that's the end of that, essentially, okay? So, and so you might say, okay, well, if you're telling me that everything is wonderful and everything's guaranteed and so on, why are you talking about risks, okay? Well, there are in fact, two risks that you have, okay? The first one is the interest rate risk. In other words, when you buy your annuity, as we are faced right now in low interest rate environment, you're stuck basically. You're not going to get as much money because we have a very, very low interest rate environment. So once you've agreed to that particular interest rate and we've signed off on this and we've said, okay, here it is, this is what you're going to get, you can't come to me 5 years from now, 10 years from now and say, the interest rates have gone up and I want to renegotiate the deal. You can't, okay? It is fixed. One of the issues of annuities, of course, is that they're not flexible. So it gives you that great, wonderful peace of mind that you know that every 15th of the month, let's say, there's going to be X dollars are going to be beamed into your bank account and all that. So that gives you that wonderful peace of mind and everything. But you should be aware that as interest rates begin to rise at some point or whatever it is, you cannot take advantage of that because it is fixed. So the insurance companies back these things up by long-term investments and everything. And so therefore, you're basically stuck with that. So there is that risk that you may not be able to get that opportunity cost in the future because they're fixed, and that's all there's to it, okay? At the same time, inflation is a major factor. So once again, if I turned around and I gave you $5,000 a month in today's dollars, you may say, that's great, $60,000 a year, I'm doing just fine, or whatever. However, 10 years from now, $60,000 a year only buys $40,000 worth of goods because we've gone through a very heavy inflationary period. I'm still only going to give you $60,000 a year. You see, regardless of the inflation, I am just going to give you the $60,000 because that's our deal. Okay, that's the deal that we cut. So you may find that down the line, your purchasing power gets eroded simply by inflation and everything else. So you say, well, that's great, but I can buy an indexed annuity. That is true. That is true. But just be aware that even though that indexed annuity, which then it goes according to inflation, so it keeps up with inflation basically, is also an expensive annuity as well. So you may find that for the same amount of money, you might find that you're going to have to put in a lot more money to make sure that you still have that comfortable lifestyle and everything else. So indexed annuities are wonderful because they do keep up with inflation, but just be aware that they tend to be more expensive annuities than a straight guarantee annuity of $5,000 a month, let's say forever and a day. But if you want it indexed, we're prepared to do that. But you're not going to get you're going to have to deposit a lot more money, or you're not going to get $5,000 to start off with. You may only get $4,000 to start off with, and then slowly it goes up. And so it's a matter of choice, really, between you and your needs are. So basically, the two risks that you have to worry about when we talk about annuities are interest rate risk and inflation risk. So you don't have to worry about business risk, political risk, all those other risks that are out there. Okay, all you really have to worry about when you buy an annuity is interest rate risk and inflation risk. So when you buy that guarantee, which is predominantly what we do in Canada, we say we're not really all that hung up on variables and everything, okay? We buy an annuity. Usually what we like guarantees. As Canadians, we tend to like guarantees, okay? So if you buy an annuity with a zero guarantee, in other words, it's a lifetime annuity. We'll look at the annuities down here. It's a lifetime annuity, okay, and it's a zero guarantee. When you say zero guarantee, sometimes you may see being referred to as what they call a straight life annuity. What that basically means is you gave me your $5,000. I gave you $5,000 back within the first month because it's an immediate annuity, and you passed away. You passed away. That's it. The money stays with the insurance company because what happens is that you bought a zero guarantee. So therefore, as long as you are alive, that $5,000 will continue on coming until the day you die. So if you die even 110, they're still going to continue on paying you that same $5,000, all right? But because you have a zero guarantee, anytime you die, there is no benefit. So in other words, in zero guarantee, there is no beneficiary. You are it. So as long as you're alive, the check will arrive. The moment you die, check stops. It's as simple as that. So there's no residual benefit. to anybody. Okay. However, it's not so bad because when you look at it, it gives you the most amount of money. Okay. So from the same deposit, in our example, the $500,000. Okay, it gives you the maximum amount of money that you could get. So if you don't have a beneficiary to leave money to, or you really need as much money upfront as possible, and you're not too concerned about what you're leaving behind and all this kind of thing here, then a zero guarantee can work very, very well for you. And today, because of the low interest rate environment, a lot of annuities are sold actually on a zero guarantee basis. That said, however, if you want that guarantee, you can in fact buy plans with a much greater guarantee. So you can buy a 2-year guarantee, 5-year guarantee. 2-year not very popular. Usually it's 5 years, 10 years, or 20 years. So what happens is that if you die within the guaranteed period, and again, just to keep it simple, let's say we're giving you $5,000 a month, and you bought a 10-year guarantee. If you died in the 5th year, your beneficiary will continue to get the same $5,000 for the balance of those 5 years. You, as the annuitant, okay, will in fact get it for the rest of your life. That's not an issue. What we're saying here is that should you die within that guaranteed period, there is a beneficiary. Unlike the zero guarantee, which said you die, it's over. Here, you do have a beneficiary. And should you die within that guaranteed period of time, then the beneficiary will receive the exact same benefit that you're getting for the duration of that time. So if you bought a 10-year, you died in the 5th year, your beneficiary will receive the exact same money as you were getting for the next 5 years, and then it stops. Pay stops. So you have a life annuity, but your beneficiaries are only entitled to income as long as you die within that guaranteed period, and only for the balance of the guaranteed period. So that's very important to remember. So obviously, the longer the guaranteed period, the lower your payment's going to be. So if you had a zero guarantee, and let's say it was $6,000 a month, is what you're going to get because you don't have anybody to leave your money to. But then you bought a 10-year guarantee, let's say, then I may only be able to pay you $5,000 a month. But should you die any time within that 10 years, that $5,000 will continue on to your beneficiary, okay? If, on the other hand, you bought a 20-year guarantee, which is, again, quite popular and everything, if you die any time within 20 years, I'm going to have to continue on paying. So I may only be able to pay you $4,000 instead of. So you see how the longer the guarantee period for the same deposit, lower monthly payments, basic. So you got to think very carefully in terms of your budget and everything else, because like I said, once you buy these things, they're not very flexible. They are what they are. They're designed to give you total peace of mind. So therefore, you never have to worry about investment options. You never have to worry about interest rates. You don't have to worry about any of that stuff at all. You just simply, every month you get that particular check. So they're wonderful in that sense. But you've got to think that once you sign that piece of paper, basically saying, okay, I'm good on this, essentially you're stuck with that payment forever and a day, okay? So when we look at the different types of immediate annuities, okay, there is what we call term certain annuities. So, for example, you want an annuity for 30 years, okay? You have young children, let's say, and so should you pass away, you want that life insurance policy, let's say, to buy an annuity that will give your spouse, your kids, an income for a period of 30 years, okay? That's what we call a fixed period term certain. The word term certain is really important here. It is certain that you will continue to get the money. So even if you died during the annuity time, so let's say in a 30-year annuity, and you died in the 20th year, for the balance of that 10 years, your beneficiary will continue to get that check until the 30 years are up. So it is certain that regardless of whatever happens to you, anytime you die within that period of time, that fixed period, that 30 years in our example, anytime you die, whatever you were entitled to will simply go now to your beneficiary. So it gives basically the beneficiary total peace of mind that if you should pass away, that income is still going to come. So you may have a dependency period, for example, where it is very important that your family continue to have a monthly income and everything else. So you buy a term certain annuity for a particular fixed period. The other one is a fixed amount. In other words, in this case here, you say, well, 5,000 isn't going to cut it. I need more than that. Okay, I need 6,000. Fine. So we fix it at 6,000, and then we'll figure out the period. So it's really up to you. You tell us what the period is going to be, and we'll tell you how much money you're going to get. In other words, we'll fix the amount. Or you can say, I need X dollars every single month, and then we will figure out what the period. But the point is, okay, is that once again, when you signed all this, it's fixed. It's done, okay? But I draw your attention to this word terms. Like term insurance has an expiry date. Term certain annuities have an expiry date. You buy them for a fixed period of time, 30 years, 20 years, whatever the case may be. If you live longer than that period, there's nothing, okay? So if you bought a 30-year, the 30th year is still alive, okay, income stops, okay? So it's just like term insurance in that, should you die within the term period, it is certain you're going to get, you're going to get that check. You die after that term period, you don't get nothing. It's the exact same thing here. Okay, so it is, but again, they serve their purpose in that you know exactly what you're going to get every single time. Okay, if you don't like the idea of a term period, okay, you can buy a life annuity. A life annuity is like permanent insurance. Okay, with permanent insurance, you get coverage for the rest of your life. And it's the same thing here. So a life annuity will give you an income for as long as you live. And once again, you can go into 5-year, 10-year, 20-year guarantee if you want to add that on as well. So here, the income continues on for the rest of your life. So you might want to think in terms of this is a term insurance sort of type of product, and this is permanent type of product. So they both serve, obviously, they both serve their purpose and everything else. Okay. The last one is joint life. Okay, so many times today, husbands and wives, for example, they will buy a joint life. So if one of them should die, the other one will continue to get an income. You see, with these here, if you die outside of these particular periods of time, you get nothing. Okay, the beneficiary gets nothing. Or even if you die within these particular periods of time, they're only going to be covered for that period. So if you died in the 15th year on the 20-year annuity, your spouse is only going to get a check for the next 5 years, and then it's going to be over, right? We say, well, that's not good. I want to make sure that my spouse will always have an income, okay? In that case, then, you will buy a life on a joint basis. So it's a joint life annuity, basically, that insures 2 lives. So you pass away, and then your spouse will receive the same income, if that's the way you set it up. Rather expensive, but it can be done. Or you can set it up, they'll get, let's say, 60%. So that way, by lowering the amount at the second death, you get more money up front. Okay, so it's all in the pricing, basically. So joint life annuities are more and more popular simply because you really are insuring, you might say, 2 lives. So one of them dies, the other one will continue on getting a pension for the rest of their lives. And once they pass away, the income stops, basically, as well. Okay, so these are the sort of the different types of immediate annuities that you should be aware of. And we'll be talking more about the other annuities in a subsequent session as well.